Hi, everyone. This is Mark Henry from Citron Cooperman. We're here today to talk a little bit about lease accounting, really preparing your private company for the changes that are coming in 2022. As I said, my name is Mark Henry. I'm a partner out of the Braintree office of Citron Cooperman. I'm joined today by Emily Rickey, the audit practice leader for our office, and Dennis Finnegan, one of our lead audit directors in our practice. Some of the things we're going to be talking about today, and really Dennis is going to be the lead going through everything, and Emily's going to be looking for your Q&A. So if you have questions as we do our presentation, please feel free to jump a question on the Q&A. Emily will be fielding those questions. We're going to try to make this as interactive as possible. So if it's relevant to the content that we're currently discussing, Emily's going to just jump in with those questions and kind of keep that conversation going. So please do feel free to make it interactive. Just to give you a quick overview of what we're planning to cover today. For those of you, Citron Cooperman, we mostly deal with privately held companies. That's the core of what the three of us on this team's invite do. But public companies, this was effective a few years ago, back in 2019. So this is a standard that's been out there for quite a few years. It's getting delayed on the private company side, and now it's finally here. Even a couple of weeks ago, there was conversation about delaying it again. That has been turned down. So now it's in front of us with a month before implementation. So we thought it was a really good time to really talk about the nuts and bolts of how this would work and how it will impact you. One note to think about. So this is calendar years 2022. There is early adoption permitted. So for those of you that are already out in front of this, or you're going through a transaction, there's a reason to get your arms around it. Early adoption is an option. Some things to think about. There's a few transition options or two. You can adopt a modified retrospective transition method or an optional cumulative effect adjustment to opening retained earnings. And that's really, Dennis is going to walk through it in more detail, but that's really how you start this process, get those on the books and the retained earnings adjustment that corresponds. So with that, I'm going to hand it off to Dennis Finnegan, who's going to start talking a little bit more about the important matters that we need to consider when we think about lease accounting.
Thank you so much, Mark. Good morning, everyone. Thank you for taking your time out of your Tuesday to sit and chat with us about the upcoming lease accounting pronouncement, talk a little bit about the mechanics. But I think to Mark's point, as he said, to kick this off, one of the most important items to go over is how this is going to impact your company's financial statements, and also how this might be interpreted by the end users of your financial statements. So before we dive into the actual pronouncement itself, I just wanted to give a real brief background on kind of how we got here. So the new lease accounting pronouncement is a genesis of the convergence projects between the domestic and the international accounting standard setters. It started about right around the turn of the millennium. They did take their sweet time to implement two big and very impactful accounting pronouncements. The first one we're all very familiar with. It's already the new law of the land with the new revenue recognition model that went live for most companies by some form of 2018. Some people did get to defer it out a little bit later for some of the off year ends. So that was the first one, and that one stole the proverbial spotlight a little bit because the lease accounting standard was actually issued within a year or two after that. And then you'll see as we go through this presentation, they do dovetail together a little bit. But the revenue recognition really did steal the spotlight, and the lease accounting pronouncement did kind of get overshadowed by that. One thing that did happen subsequently, and Mark already mentioned this, is the fact the lease accounting pronouncement has actually been delayed about 2 or 3 times at this point. But here we are, we're about a month out from when the calendar year starts for when this is going to be the new gap for lease accounting, and there's no real delays or anything else in sight at this point. And one of the most recent delay this pronouncement had was due to the fact of the pandemic and FASB realizing the world doesn't revolve around accounting standards and actually deferred it out a year. But the initial deferral was because of feedback that the FASB got from early adopters, from the public registrants, from the people that implemented this early, that this standard is a lot more straightforward than the new revenue recognition standard. It's much narrower in scope. However, it took a lot longer than people were expecting. It was a much bigger item to tackle than people expected. So they gave us an extra year of preparation. And you'll see as we go through this presentation why they did that. But I guess to then skip ahead to now what is changing. So what is changing between legacy GAAP and new GAAP? But realistically, the two most important considerations I feel coming out of this presentation are, one, obviously what is changing, how we're going to account for our operating leases on the balance sheet. But two, more importantly, I feel, is what isn't changing and what is that going to mean when it comes time to analyze a set of financial statements, because that's going to have a very significant impact as well. So let's start with the headliner. The big change is now under new GAAP, all leases, regardless of classification, will now be parked on the balance sheet at the origination of the lease, when the lease starts, or the implementation of the new lease accounting standard. Now, what do I mean by lease classifications? Under a legacy GAAP, lease accounting fell into one of two dominant classifications. One was a capital lease, which we're all fairly familiar with, and the good news is that the treatment for a capital lease under the old standard and under the new standard are effectively the same. So nothing earth-shattering there, but either a capital lease, which was parked on the balance sheet as a lease liability, you treated it kind of sort of like debt. You had a asset you capitalized on the balance sheet, you depreciated it on a straight line basis over the term of the lease, and that was the only lease that had material impact on the balance sheet. Operating leases had some nuances that could impact the balance sheet, but for all intents and purposes had minimal balance sheet impact. The operating lease name is carrying over. So under the old GAAP, you had either a capital lease or an operating lease. And under the new GAAP, you're either going to have a finance lease or an operating lease. Now, the finance lease, like I said, is just renaming the capital lease. The mechanics are almost the exact same. So we'll cover those fairly briefly in this presentation. But the big change is, one, now operating leases will interface with the balance sheet. You will have what they call a right of use asset and a lease liability that will need to be amortized. But here's kind of the kicker, is that the income statement and cash flow impact of an operating lease under legacy GAAP and under the new lease accounting standards are going to remain effectively the same, which is a little confusing to think that, wait, so you're telling me I'm going to have to gross up my balance sheet for this right of use asset and for this lease liability, but the income statement effect is going to stay the same? How do I get these things off my balance sheet once I put them there? And the accounting got a little bit more complicated, and it got a lot more judgmental than what it has been in the past. So it's going to have an impact on the statements, and also it's going to have an impact on how the end users of your statements are going to read them. And I think really the key thing to walk away from this is the underlying economics of most of the leases they're not changing. The cash was still going to go out the door regardless of where it was presented. It's just now, instead of being on page 14 or 15 or 16 of your footnotes, your financial statements, the operating lease asset and liability are now going to be parked on your balance sheet for all the world to see. And that's by far and away the most impactful thing. And that could potentially impact some covenants. That could potentially have some impact on how some ratios are being calculated. And realistically, that's the most challenging part of this new lease accounting standards. We all have these golden ratios in our head that, debt to equity needs to be this and current ratio should be this. And those are all going to be impacted by the standard. So we're going to talk through that as we go through the presentation. So take a step back at a conceptual level. What FASB has determined a lease to be hasn't significantly changed under the new lease accounting standard from the old lease accounting standard. It's still the basic idea that you have an asset that you have a right to use or direct over a certain period of time in exchange for your consideration. One point of emphasis they did make on the definition of a lease is that the lease can be explicitly stated with obviously a formal lease document, but has somewhere that says this is a rental agreement, et cetera, et cetera, et cetera, or it can be implicit based on the facts and circumstances that are within the contract. And it doesn't necessarily need to be the entirety of the contract. So you could have a lease that is a component of a contract that has other non-lease components bolted in. And there are some options the companies will need to evaluate when it comes time to considering that from the mechanics you're going to need to do of the calculation of your right of use asset and your lease liability. I know that all sounds a little confusing. We have some slides later on where we kind of break that down and make that a little bit more bite-sized, but that's where we're going to go. And that's how you identify, okay, yes, I have an asset that I am using for a certain period of time and I'm paying somebody to use it. So now I know that, what do I do? So like I said before, there's two dominant types of lease classifications from a lessee's perspective. You'll have an operating lease and then a financing lease. Under legacy GAAP, the difference between what used to be a capital lease and an operating lease was a 4-prong test. Under the new leasing standard, they're materially the same, but now there's a 5-prong test. Biggest changes being that instead of having prescriptive bright lines, for example, that it used to be if the lease term was over 75% of the economic life of the asset, or if the present value of the lease payments was 90% of the fair value of the asset, that has now been replaced with more open-ended and more interpretive language saying major part, substantially all. So much less prescriptive than the original GAAP, and much more now influenced by management's judgments and estimates, as opposed to being a very, here, this is your cookbook from FASB on how to account for a lease. There is one new prong to the test that did get added, and that is a little bit of an inside baseball, item to deal with, is if the underlying asset is very, very specialized in nature and has no alternative use to the lessor at the terminus of the lease, then regardless of if any of the 4 prongs above are hit, that's going to push it to finance lease accounting. Which, when I say finance lease, just again, think of capital lease that we all know and love under legacy GAAP. And those are the biggest changes right there. So then, okay, now we've conceptually identified we have something we consider the lease, we put it in a classification bucket. Now what do I do with it? And this is where the big changes start, is now under new GAAP, regardless of what classification of asset you book it to, you're going to record a right of use at a lease, calculate a lease liability, and then record an offsetting right of use asset. Now, how do you calculate that lease liability? The lease liability under the new lease accounting standard is the present value of the future minimum lease payments over the term of the lease. Now, just in that one very simple statement alone, there's basically 3 very significant judgments and 3 very significant determinations that need to be made in order to calculate what the present value of the lease payments are. First off, you need to know exactly what the lease payments are, what lease payments get considered in this calculation, what lease payments get excluded from this calculation, and it's not as straightforward as you think. Secondly, you need to figure out what exactly is the lease term. How long am I going to be present valuing these cash flows for? What do I consider, especially if my leases have options? How do I deal with those? And then lastly, I'm present valuing a future series of cash flows. So in order to do that, I need to have a discount rate to use. And the last question to answer there is, well, what can I use for a discount rate? So I guess we'll just kind of unpack those one at a time, just for the sake of everyone being on the same page. As far as what the lease standard says for the lease term consists of the non-cancelable portion of the lease plus any lessor options, because lessor options absent evidence to the contrary are assumed to be exercised. So it would be the original portion of the lease plus any exercised options to extend by the lessor. And then if there are options for the lessee to extend, it needs to pass a reasonably certain test in order whether or not you consider those lessee options to be exercised in the lease term. Now, what does reasonably certain mean? Unfortunately, FASB does not define that number, does not define what that means for us. There is no bright line from FASB to say that reasonably certain is over 75% certainty. They did state it is a threshold that is higher than probable. So it is a fairly high degree of certainty that you're going to exercise that option to extend the lease term, and therefore consider that portion of the lease term in the present value calculation. So really what it's going to come down to is a lot of qualitative and quantitative factors. Is the option at a defined lease? Is it the option at a defined rate? And is that rate below market? Or is this location critical to operations and there's economic or business disruption incentives for the company not to move from that location? The more that location is critical to operations, the more it would make sense for the company to retain where it is, the more likely it is that you would consider those options in the lease term. Second, you got to figure out, okay, Now I know how long of a period I am. How much do the payments need to be? So the FASB defines the minimum lease payments that need to be paid as the stated minimum non-cancelable payments in the term, so your base rent that's fixed. Any in substance fixed rental payments that are based on a variability that is so certain to happen that they are in fact really fixed payments. And lastly, if there are any variable payments that are based on a known rate or indexee at the time of lease inception. So for example, CPI or an interest rate like LIBOR, that number is set at the inception of the lease, and that number is known, those are pulled in as fixed lease payments. If there are any lease payments that are variable for other factors, those are generally excluded and not considered a portion of the future minimum lease payments. So for example, if you're in a retail environment and you have a lease that has a component of the lease is related to the sales volume at the location, and it's a percentage of sales, those are not considered the future lease payments in the present value calculation, and therefore excluded and incurred as recognized in the period in which the sales happen. Or if you have a lease that has a hours use on a piece of equipment, that is again not considered in the present value of the future lease payments, and rather that is considered a period and expense in which those hours are incurred. So now you have how long you're going to be present valuing the lease payments. You have the amount of the lease payments that you're going to be present valuing. The last piece is the discount rate which you'll use. And under the new leasing standard, FASB gives you 3 options for this. The first option is the explicit interest rate stated in the lease. So if the lease has an interest rate that is on the face of the lease, then that's the end of the discussion. That's the rate you have to use. That being said, on many leases, you're going to have an easier time finding the Patriots passing offense from last night than you will finding the explicit rate in the lease. For non-sports people, that's a needle in a warehouse full of haystacks. It's very difficult to find. A lot of leasing companies aren't required to disclose it and won't disclose it. A few exceptions being in the case of vehicles. The truth in lending requires that information to be disclosed to the consumer, or in some equipment leases, they might indicate what the explicit interest rate is. But in a lot of cases, that number is not known. And FASB has actually gone out and said you cannot try to calculate that number. You cannot use industry data as a surrogate for that number. You either know it or you don't. And if you don't know it, if it's not stated in the lease, you need to move on to the your incremental borrowing rate. So what the incremental borrowing rate is under the new lease accounting standard, that is interest rate for any collateralized debt under similar economic circumstances, but doesn't necessarily have to be the debt that you would need to incur in order to buy the specific asset you're trying to lease. So stated differently, it doesn't mean you need to figure out what the interest rate would be for a loan to necessarily buy the asset you're leasing. It can be any collateralized debt under similar terms and under similar economic circumstances. So it gives you a little bit of wiggle room in there. But again, it's a fairly significant judgment. It's a very significant estimate that management needs to make. Further, if you're a privately held entity, there is one practical expedient that is available to you to help relieve you from a lot of that work, and that is you can use the applicable risk-free interest rate on the lease, or excuse me, you can use the applicable risk-free interest rate in the market at the time of lease inception or implementation of the new leasing standard. So what that means is you can use a very, very low risk-free rate in order to present value your future cash flows. But the enormous caveat I will give you with that is the fact that since you're present valuing at a very low interest rate, that's going to give you the largest lease liability and the largest right of use asset. So for the ease of that calculation, you are leveraging your balance sheet up the most. Now, The FASB just recently in September did issue a clarification on the pronouncement saying that companies, originally this was an all or nothing election, saying that if you elected to use the risk-free funds rate, you had to use that for all assets. That was the only interest rate you could use at the lease inception. FASB has since kind of backed off that position and has since stated that you can do this on an asset by asset class election. So if you have a lot of copiers, if you have a lot of small equipment that it's not worth the time, talent, and energy it would be for you and your staff to go through and figure out what the incremental borrowing rate is, you can make the election to just take on those on office equipment asset class that I'm just going to use the risk-free rate of return on that one and just move on. So once you've calculated all that, you're going to take your future minimum lease payments, you're going to aggregate those up over the term of the lease that you just identified, and then you're going to present value those. And that present value number is going to get parked on your balance sheet as a lease liability, and then you're going to book on day one a right of use asset. So unlike operating leases under legacy GAAP, where it is effectively minimal to no impact on your on your balance sheet on day one of the lease accounting, under the new lease accounting standard, your balance sheet is going to be impacted on day one of the lease or on day one of implementation. I just threw a lot of information at you. I just want to pause for a quick second to see if anyone had any questions on that.
Do we have any questions in the chat so far?
Okay.
Thanks.
All right. So with that said, all right, so now I have a lease liability and a right of use asset on the balance sheet. What do I do? How do I get them off? How do I get rid of these things now that I've booked them there? So again, under a finance lease, mechanically, it is the exact same as a capital lease under legacy GAAP. You will amortize the asset on a straight line basis over the term of the lease. You'll calculate and recognize interest expense on the lease liability. And as you make payments, the lease liability will decrease. Again, it's the exact same, almost the exact same as a capital lease under legacy GAAP. So it should be a concept most of us are familiar with. Where it gets a little confusing, like I said, is on the operating lease. You will impute interest on the operating lease. You will calculate amortization expense on the operating lease. And those two items will drive how much the right of use asset and the lease liability decline over the term of the lease. However, the only item that will actually impact your income statement will be the straight line rent expense over the term of the lease. And if that sounds really, really confusing, that is because it is. And we're going to walk through an example in the next couple of minutes where we kind of put some pen to paper and kind of flesh out this concept. So bear with me on that. There we go. So for the next couple slides, we're going to do an example just to kind of walk through again, like I said, to try to put some numbers to the debits and credits here to help make some sense. Will you do both a finance lease and an operating lease example? I will go through the finance lease example a little expeditiously just because of the fact it's very similar to a capital lease that we all are reasonably familiar with at this point in time. But for purposes of walking through the example, we're going to pick a very simple lease. It's a 3-year lease. It has minimum lease payments of $200,000, $300,000, and $400,000 due at the end of each year. The discount rate we're going to use is 5%. The present value of those lease payments is $808,120. Feel free to check my math. The straight line rent expense is just the aggregate of the 3 years worth of lease payments divided by 3 years. So $900,000 worth of payments over 3 years is $300,000 a year of annual payments. And then we're going to assume, for sake of simplicity, there are no variable lease payments.
Dennis, I think we had a question. You had talked about certain components not being included in the future rent payment, which I believe is the variable lease payments. Can you just retouch on that, what you would not include?
Of course. Thank you. So as far as what we mean by variable lease payments, like I said, those are lease payments that are based on something other than the passage of time. So your minimum lease payments are going to be the minimum lease payment stated in the lease, plus any variable lease payments that are based on a rate or indices. So if you have a lease that states that at any point during the original term of the lease or at any point in any option to extend the lease, that is either a lessor option or is a lessee option that is reasonably certain to be exercised. If they're based on something like the change in CPI and that base year of CPI is fixable, then those lease payments are considered in the present value calculation. Those lease payments are considered in the future lease payments. If there are any other variable lease for something other than the passage of time, so if you have something that's based on usage, you have something that's based on revenue generation, anything like that, those are considered period expenses in which during the time in which they are incurred, they do not get captured in the present value calculation. So then moving on to the finance lease example, and again, I don't want to spend a ton of time on this just because this is a concept that we should be reasonably familiar with at this point. But on day one, you're going to book a opening balance of 808,120 on the right of use asset. You'll book a lease liability of 808,120. You'll recognize depreciation expense on a straight line basis over the term of the lease. That'll go through your COGS or your SG&A. You'll have a lease liability. You'll impute and recognize interest expense. In this case, the 40,000, 32,000, and 19,000 over the term of the lease. And then you'll amortize that off. That'll work its way through your P&L with the interest rate component, the interest expense component going through your other income over the course of the lease, and your amortization going through either your SG&A or your cost of goods sold over the term of the lease. Your interest expense is considered an operating cash flow. The actual payments you make on the lease liability will be considered a financing cash flow, and that is how the financing lease will behave. Again, mechanically identical to how capital leases were treated under the old leasing standard. Where it starts to get a little confusing is on the operating lease example. So this looks very familiar. The operating lease amortization schedule looks the exact same as the financing lease amortization schedule, and it is true. Under an operating lease, like I said before, you will impute an interest. You will calculate an amortization, but note that the amortization is not on a straight line like it is under a finance lease. And you will amortize both a right of use asset and a lease liability. Now, the big thing to take away though is of all of this calculation that's going on related to the lease, the only component of this that will actually relate to your income statement is the straight line rent expense over the term of the lease. And like I said, all the straight line rent expenses is your total lease payments over the term of the lease divided by the number of periods under the lease. And that's the only component that's going to go through your P&L. So even though you're going to calculate interest, you're going to calculate amortization, they're not going to manifest themselves on your income statement. The only place that actually manifests on your income statement is the straight line rent expense. Now, if that seems a little confusing, that's because it kind of is. So what I'm going to do is in a couple slides, I'll show you the journal entry that you're going to have to make at the end of the month. And we have a couple slides later where we talk about how that impact that's going to have on your income statement and your balance sheet on day one and as the lease is in service. But the big takeaway is that even though the operating lease is now going to get parked on the balance sheet and it is going to be amortized, you're not going to get the benefit of interest expense or amortization, which are of course both components of how EBITDA is traditionally defined. And EBITDA obviously being earnings before interest, taxes, depreciation, and amortization. So where this is going to go from a presentation perspective, again, this line item here, while you are imputing interest and calculating amortization, the only place it's going to manifest on the income statement is the total expense of $300,000. And then in your operating cash flows, you have the $200,000, $300,000, and $400,000 a year of actual payments as they get paid out. So how that works from the debits and credits, this is just a very simple journal entry of what your first year worth of payments will look like. So the first component we kind of understand here, the actual cash payments are $200,000 because that was the first year payments. The $300,000 is the expense you'd recognize. Under old GAAP, under the old leasing standard, you'd recognize the difference would go to an accrued rent that you'd build up on the front end of your lease. And then on the back end of the escalating lease terms, you'd bleed that back into the P&L. Under the new leasing standards, since now you have to amortize both a right-of-use asset and a lease liability, your right-of-use asset is amortized at a rate that is the difference between your straight-line rent expense and your imputed interest, and your lease liability is amortized as the difference between the actual cash payments made and the interest imputed on the lease liability. Stated differently in a more simplified approach, in all of this whole journal entry, 3 out of these 4 lines are balance sheet accounts. The only line that'll end up in your P&L is this rent expense here. So then what is that? That's great and all. We've been through the mechanics of, okay, this is how we identify, this is what we conceptually think a lease is. This is how we identify what bucket the lease we're going to put it in. This is how we calculate what that amount, that quantify what that dollar amount's going to be. So now the next question becomes, okay, how do I treat this on my balance sheet? What do I do with this? What is the impact this is going to have on my financial statements? So again, for this example here, for this slide, I'm going to just assume the impact of an operating lease. And again, the only reason I'm only assuming the impact of an operating lease is just due to the fact that the capital leases mechanically are the finance leases are mechanically the same as the capital leases. That shouldn't be a surprise to anyone. But the operating lease, oh, did I just lose my screen here? Oh, sorry, my apologies. The operating lease will be a very different impact on the balance sheet under the new lease accounting versus under the old lease accounting. So the way we look at this balance sheet, the column on the left here is the lease accounting standards under legacy GAAP. And this is the only difference between these 2 columns here is the application of 842 to the existing leases. There is no other change between the 2. The underlying economics of the 2 leases are the exact same. So on day 1, under old leasing standards for an operating lease that we just used in our example, there is no balance sheet impact. There's no asset to record. There's no liability to book. It's strictly a total period expense for this part on day 1. Under the new leasing standards, you have to book a right of use asset and the lease liability. Important thing to consider with this is that in addition to having to gross up the balance sheet for both the lease liability and the right of use asset, the right of use asset is going to always be considered a long-term asset. There's never going to be a current portion of that lease that right of use asset. Conversely, for your lease liabilities, you will have to break that out between a current portion and a long-term portion of your lease liabilities. So what does that mean? That means on day 1, with no other changes being made other than the adoption of 842 or the new leasing standard, pardon me, that your working capital is going to be detrimentally impacted because you're going to have a current portion of a lease liability with no offsetting current asset. So in this example, your working capital slid by the approximately 160,000 of current portion of the lease liability. So that's a decline of almost 8%. As you would expect, the current ratio slid from 3.4 to 2.86. So you read that as under the old leasing standard, the way your balance sheet was presented, you had $3.4 of current assets to cover any dollar of current liability. And now that has slid from 3.4 to 2.86, which is a decline of nearly 16%. And then your debt to equity, which is basically reads as for every dollar of debt you have every X number of debt, you have a dollar of equity. So prior to the adoption of the new leasing standard, you had $2.35 of debt being burdened to every dollar of equity. Because you're grossing up the balance sheet for this new liability on a traditional definition of debt to equity, you've now increased that amount to now you're up to $3.20 of debt for every dollar of equity you have in the company, which is a 36% increase. So it makes the balance sheet look much more leveraged. And again, the only difference in these 2 scenarios here, the only difference is this is day 1 accounting under the old leasing standards. This is day 1 accounting under the new leasing standards. So that's going to be your impact in your balance sheet on day one. And a lot of people see that. Oh, a question, Emily? Sorry.
Oh, sorry, not a question. I just think just kind of maybe get a little commentary from our team on kind of what's going to be happening, with covenants. I think this is an important slide to maybe pause on, just kind of take note of that. I think that's really the meat of what's going to change for a lot of businesses. Most of them have financial covenants, so it's just really important to kind of understand what banks are going to be doing with the new accounting standard. As you've kind of shown what's going to change with the metrics on that slide before. So I think kind of what I've seen is it's maybe a little bit of a wait and see mentality as to how it's going to be approached. For the short term, the new lease items might get backed out of the original covenant, and then formal amendments might come as the adjustments are better understood. Mark, I don't know if you've seen something different or kind of what the consensus is out there.
Yeah, something similar. And I think we do have a fair amount of bankers on the call. So if you guys are seeing it a different way, please chime in and we can share some of your thoughts. But basically what I've seen is a little bit of a wait and see mentality where they know the economics of the business aren't changing. Cash flow is still the same, right? Before and after lease adoption. But as Dennis highlighted, all the ratios that banks and a lot of us are using to kind of just value your business and determine how leveraged you are all going to look different and worse after the adoption of 842. So it's something to keep your eye on. I think what we're doing with a lot of our clients is trying to get our arms around it now so that when we go to a lot of line of credit negotiations or after your year-end closes sometime in the summer, is to really get an understanding of what those will be so we can update the ratios and that we don't trip a covenant for no reason going forward. But basically, I think that the general consensus I'm hearing from banks is that they're gonna take the impact and kind of update the covenants, at least for year one adoption, update the covenants and back it out for year one, and then go forward reset. So it's just good to get your arms around it as soon as you can.
Yeah, and to that point, I think probably the biggest takeaway from this slide and also from the next slide where we have an example where we talk through what the impact of an operating lease is going to look like from a very simplified debt service calculation is this is a good opportunity to have the intelligent conversations with the end users of your statements that for most of the leases we're going to be implementing that are going to be subject to the new lease accounting standards. A lot of them are in service as of the end of 2021, and you obviously will know what will be in service as of 2022. So you can obviously at least piece together on a rough fashion, what is this going to look like on my balance sheet? What is this going to look like on my income statement? And then have that conversation with your banker or with your surety or with your other end user of the statement, potentially if it's private equity ownership or if it's vendors that get your financial statements or whatever the case may be, just to alert them that, to Mark's point, the underlying economics of your leases aren't changing. That cash flow was going to go out under the old lease accounting standards as well. And we did disclose that, but that disclosure was way down in page 9, 10, 11, 12, 13 of your financial statements. Right now, under the new lease accounting standards, they are going to be parked on your balance sheet for the world to see.
Yeah, the one thing to add to what Dennis said, I do like about this standard is one of the issues you had before, just keep a simple business, right? I'm an owner operator, I have an operating company, and I have a mortgage on a building, right? So the leverage associated with that business looks different than if I own my business and rent my building, right? So by pulling these on the balance sheet now, at least when you're trying to compare leverage models between business to business, you're going to be able to align them a lot better. So there is some advantages of this new lease standard. There's going to be a lot more comparability, but in terms of the economics of the business, again, it's not going to change.
So then in that same light, just taking a quick look at what a very simplified debt service calculation might look like versus under the new leasing standard for an operating lease and for a financing lease. So we'll go with the easy one first. Under a financing lease, the major components of EBITDA, you get the amortization on your right of use asset and your interest expense on your lease liability. You get to add those components into your EBITDA calculation as it's traditionally defined. So in this case, under both the old leasing standard and under the new leasing standard, if you have two companies with two identical leases, but one classified it as a financing lease, one classified it as an operating lease, the company that classified the lease as a financing lease is going to have almost $310,000 worth of additional EBITDA under these facts and circumstances than the company that classified it as a operating lease. So that's over 62% increase in EBITDA, which obviously is a stand-in for cash flow. So then looking at a very simplified debt service calculation being your EBITDA divided by the fixed charges you're going to have to pay in the next 12 months. So it's under the financing lease agreement. That is exactly the same as it was under the capital lease agreement under the old GAAP. So you're at $2.25 of cash flow for every dollar of debt service. You're at $2.25 under the new lease accounting standards. Where this gets different is under operating lease, under the operating leases. Under the old lease accounting, you had no balance sheet impact. You had no current portion of a lease liability that could get pulled into a fixed charge calculation. So you're prior to the adoption of the new lease accounting standard, you had fixed charge coverage of about 250 to 1. Now, under the new lease accounting standards, not only do you not get any add backs in your traditional definition of EBITDA under the new lease accounting standard, you also potentially have some current portion of a lease liability that needs to get pulled in under your fixed charge. And again, to Mark and Emily's points from the last slide, why are we showing you this kind of very simplified, very kind of worst case scenario or almost shock value approach on the numbers is just because it is important to quantify and to know what this impact is going to be on your financial statements. And that way you can have those intelligent conversations with the stakeholders of your financial statements to know what the impact is going to be and explain that it's the accounting that is changing. The economics and the actual activity are not. It's merely the medium in which they are expressed. So then just going through a couple more technical slides, and we'll hand it off to Emily, and she'll talk through some of the more practical implementation pieces. But FASB can't help themselves with enhanced accounting. Will also come some enhanced disclosures. I'm not going to go through this giant wall of text with you right this very second, but I'll give you in the summation. Right now, most companies lease accounting footnote in the footnotes of the financial statements are probably somewhere along the lines of maybe a half a page to 3/4 of a page long. Because there's a lot more judgments and a lot more calculations and a lot more estimates now in the new lease accounting pronouncement, you can expect that disclosure to expand to about 1.5 pages, maybe even 2 pages in some cases, because now you'll have to disclose what the weighted average discount rate is used by lease classification. You'll have to disclose what the weighted average present value is by lease classifications. You'll have to break out your variable versus non-variable rent expense, those sort of things there. So you will have some additional disclosures that will go with that as well. But all is not totally lost. FASB does give a small suite of practical expedients to help implementation be easier for a lot of companies. The suite of practical expedients isn't quite as verbose as it was under the new revenue recognition standard, but there's a few that are worth highlighting. The first and probably most impactful of those is the no reassessment of lease classification upon implementation of the new lease accounting standard. So basically stated in more simplistic terms, that allows you to grandfather in some of the lease classifications you had under old GAAP. Now you still have to apply the new leasing standard to the grandfathered lease. So operating leases are still going to get parked on the balance sheet. However, you don't need to go back and reassess. You can make the practical expedient to say it was good under the old leasing standards and now it's good under the new leasing standards. There's also no reevaluation for expired or contracts that are in process at the date of ASC 8 at the date of the new lease accounting pronouncement application. There's no need to go through and reevaluate them for an embedded lease at that point. Now, please note that get out of jail free card works exactly one time. The only time that works is on the implementation of the new lease accounting standards. On a go forward basis, you will need to evaluate your contracts for embedded leases. And they, like I said, a lease can be an explicit contract, but it can also be an implicit contract that is buried in another agreement. So you might have some service agreements with some IT providers. If they're providing some equipment and you get the ability to direct the use of that equipment over a certain period of time in exchange for some fixed consideration, that might meet the definition of a lease, and that might need to be applied to lease accounting standards might need to be applied to that. Or if you're a general contractor and you have a subcontractor that you're going to have on site for 3 years, and they're going to bring an asset like a crane, and that's going to be on your job site for 3 years, and you as a general contractor have the right to direct the use of that crane, depending on how that payment structure is set up, you might need to apply lease accounting to that as well. I'm just the messenger, but luckily for implementation, they do give you a little bit of a get out of jail free card there. There is no reassessment of the initial direct costs. This is a little bit of an inside baseball rule, but the definition of initial direct costs under the new leasing standard is much more narrow in scope than under the old leasing standard. So if you capitalize any initial direct costs with your old leases, FASB's basically saying we're grandfathering those in. We're not making you impair those all in the year of implementation, push those all through retained earnings at that point. You do get the use of hindsight to reassess any leases that were assessed as one class of lease under the old leasing standard and now will be assessed as a separate class of lease. And they also give you the practical expedient of combining lease and non-lease components in a contract where the lease is not the only component of the contract. But please note that check valve only goes in one direction. You can only add things to the lease. FASB does not allow you to pull items out of the lease. And lastly, as I discussed before, for privately held entities, FASB does allow you to use the risk-free rate of return as your incremental borrowing rate to determine the present value of the future lease payments. So sorry, that was a lot of talking. I just wanted to pause for a second and see if we have any questions or comments.
Yeah, I think a couple, maybe just to touch on quickly. Obviously, the standard has kind of been hanging out on the sidelines for a couple of years now. So there's been some kind of common situations and questions that have maybe been brought up a little bit more generally until we kind of get to this specific thing, but kind of other important items to consider. Lease modifications. I think that's going to be a pretty common scenario for clients. And then, I think we talked a bit about variable lease payments, but just how you kind of would incorporate the changes there or any other items. So
as far as lease modifications, so under the new lease accounting standards, it's kind of a decision tree type process you need to walk through. If the lease modification increases the right of the asset that you have the right to use, and there is an increase of cost that is commensurate with that, then that variance, that delta, that increase on that lease amount is considered as a separate lease, and that is then has the new lease accounting standard applied to it at the time of its origination and inception, and is carved out as a separate lease contract. So you present value the separate lease payments at whatever applicable borrowing rate you use at the time. If the lease modification reduces the right of use asset, then at that point, there'd be a reduction in the lease liability on a pro rata basis. The offset is there would also be a reduction on a pro rata basis to the right of use asset as well. And any difference between the two would run through as a gain or loss on the disposition of the component of the lease. Further, another thing to remember, and I don't want to go spend too much time on this one, but now you do have another asset on your balance sheet that is now in theory subject to impairment. So you could have an issue where you could actually have to impair your right of use asset depending on how facts and circumstances might pop up. And then lastly, if there's any other changes to the lease that would change any of the major components such as term, payment, right, the asset that you have the right to use, that would trigger a reassessment of the lease on a go-forward basis. As far as the variable lease payments, like I said, if they're fixed, then obviously they get pulled into the present value. If they're fixable, either via a very low bar of variability to pass over, or you have a lease that is based on a rate or indexee that is known at the time, then those get pulled into the present value calculation. If they're variable for any other reason, generally speaking, they're excluded. So, I'm sorry, what, Emily?
So thanks.
Of course. So lastly, I've been talking a lot on some very dense, very dry FASB items. There are some good news that is built into this pronouncement because the new leasing standard was issued effectively in concurrency with the new revenue recognition standard. They actually dovetailed the two in reasonably well and simplified one very specific transaction, and that would be the sale leaseback transaction. So sale leaseback transactions under legacy GAAP, under the old leasing standards, were very confusing, very challenging items to, or very challenging transactions to account for. And that's just because of the sheer volume of moving parts. You have to consider the transaction from a legal perspective, you have to consider it from a tax perspective, and then lastly, you have to consider how you're going to account for it under an accounting perspective. But I'm not going to go into great detail on this, but under old GAAP, what typically happened in the best case scenario, all or a portion of the gain of the sale on the sales component of the transaction was subject to a test of how much the present value of the subsequent leaseback payments were. And depending on how much that amount was, that gets parked on the balance sheet and deferred. That revenue gets deferred out and amortized back into the income statement over the subsequent leaseback. That's the best case scenario. So best case scenario, in many cases, you were recognizing a portion of your income in the year of the sale, and then the rest of it gets amortized off over the term of the subsequent leaseback. Worst case scenario, if the leaseback was a very large substance relative to the fair value of the asset that's getting sold, then it gets treated as a financing. And even though you legally sold the building and you recognized a tax gain or loss on the sale, you, for financial purposes, have to make believe you still own it, and you depreciate it, and you book this debt, and it just is a mess. It's no fun to deal with. So one thing they did correct it was the treatment of the sales leaseback under the new lease accounting standard and under the new revenue recognition standard. And generally speaking, they simplified the approach. They simplified the thresholds that needed to be met. So you can now have full gain accounting on the sale component of the transaction in the year in which you sell the asset that you are subsequently leasing back. So you get to recognize the full gain on the sale. And then, of course, you have the leaseback piece is then subject to the new lease accounting standards, where you have to book a right of use asset and lease liability. However, there are some catches. First off, the sale of the property needs to be point to control has to transfer to the buyer of the new property under the new revenue recognition standards, specifically steps 1 and step 5 of the new revenue recognition model under ASC 606, meaning that 1, it has to be an enforceable contract, and 2, consideration needs to be paid from the buyer to the seller. Secondly, the leaseback between the buyer lessor and the seller lessee needs to be an operating lease to the lessee, because they need to transfer control of the asset, and it's very difficult to transfer control of the asset if the subsequent leaseback is a finance lease. And then lastly, in most cases, a repurchase option will make it slightly more challenging. The big caveat is if the asset is non-specialized in nature and the repurchase option is at market value upon exercise, then that still can be considered for sales leaseback accounting under the new leasing standard. So there is some good news. It does simplify that. This is an opportunity for some companies to generate some cash if need be. And it's a creative way of doing it. And this did simplify what was a very complicated transaction from an accounting perspective prior to that. So I've thrown a lot at you. At this point, I'm going to hand off to Emily, who's going to talk through some of the implementation and some of the next steps now that we've gone through, conceptually, and the concepts and the mechanics around the lease accounting. So thank you all for your attention this morning. Appreciate it.
We actually had a couple of questions, Dennis, that I think
Sure.
Just go back a couple slides to refresh. That would be great. So on the debt service coverage, the question is just kind of revisiting why that would decrease under the new lease. I think just kind of covering the classification of the fixed charge.
Yep. So the reason why in this case under an operating lease, because this is relative to old lease accounting versus new lease accounting. So remember, under old lease accounting, there is no current portion of the lease liability. Under the new lease accounting, there is. If we actually go back one more slide, you can see here, Under the old lease accounting, there is no current portion of the lease liability. Under the new lease accounting, there is. And for purposes of this example, I just wanted to highlight that depending on how covenants might be written, that the current portion of your lease liability might meet the classification that covenant calculation might consider to be fixed charges that need to be factored in to your fixed charge ratio, and therefore gets pulled into the covenant calculation.
All right, great, thanks. I think the other couple of questions that I'll just go through quickly is asking about leasehold improvements. Don't believe those are under the scope of 842 unless you have a lease incentive or something like that. I don't know if there's anything else really you want to add.
Actually, that's a great question, a great point to bring up. The leasehold improvements, yes, they are outside the scope of the new lease accounting standards. They are under fixed assets. However, important thing to remember on leasehold improvements is that they need to be depreciated over the shorter of the useful life of the asset or the underlying lease. And there is one other item that I didn't touch on that I realistically should, is that there is a component of the new leasing standard says that if the lease is a 12-month or under lease, then the new lease accounting standards do not apply. It is strictly a period expense that goes through the income statement in the period in which the rent incurs. That being said, that 12-month exception, that short-term lease exception, is based on the date of origination of the lease. It's based on the whole term of the lease. So the entirety of the term of the lease needs to be under 12 months. It can't just be the remaining balance of a lease. And remember, with leasehold improvements, if you have a leasehold improvement on the books, like I said, it needs to be amortized over the shorter of the lease term or the useful life. So if your lease term is only 11 months, you have to amortize the entirety of that leasehold improvement over 11 months in theory.
And then I think the last one was just on adoption. So asking if you're not adopting until 2022, what should be disclosed in 21? I think that's really just going to be a qualitative disclosure, just kind of talking about the upcoming lease standards and kind of quantifying it that way in the footnote there.
Yeah, typically what you'll see is a disclosure very similar to what was under the new revenue recognition disclosure. It's called a recently issued but not yet adopted, where it'll discuss the lease accounting and it'll discuss at a high level what the impact is going to be and that you're still working on your assessment. That being said, like Mark said, early adoption is permitted. So if you have something like a sales leaseback transaction going on in 21, or you have some very significant leases that are hitting in 2021 and you just want to get ahead of it, potentially early adoption might be a good option, or at least something to consider.
And I think also another point is when we made the disclosures for upcoming changes for revenue recognition, most people were not materially affected other than additional disclosures and changes. The lease accounting is a little different in that there's potentially more of a material change to your balance sheet, depending on the type of lease that you have and what's going on there. So there may be a quantitative disclosure included as well. So we'll kind of jump in now to some of the next steps. Dennis has given us a lot of very useful information, which was summarized really well, which isn't an easy thing to do with a standard like this. But as we wrap up, we just kind of wanted to leave everyone with a few actionable takeaways, hopefully over the next year or so. So again, as we talked about at the beginning, this is effective for fiscal years ending after 12/15/21. So pretty much 12/31/2022 will be the year that everyone has to really start implementing. So we would encourage you to take on some of these steps over the summer. Don't wait until the fall or right before year end, because you can kind of get into the details and realize it might be a little more complicated than what you originally anticipated. So to start out, really just take an inventory of your leases. There'll be some easy ones, your office lease, auto fleet, copier, other machinery, but there may also be some that have that kind of embedded lease component that Dennis talked about. So this is where you have that contract, doesn't have the word lease in it, but there might be a specified asset that you have the right to use. Some examples, again, would be, an IT arrangement, inventory management, warehousing, maybe some bundled packages where you have services and devices mixed together. So one kind of tip would be to look at your vendor payments, run that report, sort it over a material threshold, and really take a look at what type of agreements, explicit, implicit, you have with those vendors. And then once you've kind of identified all those leases, then you'll have to start really accumulating the information that's needed for the actual accounting entries that we went through. So figure out what rate you're going to use. Is it going to be the risk-free rate, implicit rate, the incremental borrowing rate? Figure out the lease term. That's where some of the management estimate and judgment will come into play. If you have some possible extension or renewal language in the contracts, really determining what estimate you're going to use there. And then again, just looking at all of the components of the agreements. Are there non-lease items that need to be broken out? Other things that need to be considered as you kind of dive in. And I think too, if you want to just go on to the next slide, Dennis, that would be great. Once you have some of that basic information gathered, we're here to help you with that process. So we can run through projections and kind of determine from a high level what covenants might look like under the new standard. I know this can be a bit of an overwhelming undertaking, so we're also available to help provide guidance on what might be considered material or how to kind of start to attack the project overall. And typically, if you have, more than 10 leases or the leases are more complex, you'll probably want to use a lease software package. There's a lot of options out there. We can kind of give you a couple of recommendations based on what might fit your needs. Again, if you have more straightforward leases or just a few, we have an Excel tool that might be more cost effective that can kind of help manage it without using a software. And then again, once you've really quantified what that new standard means, we can help to shape the conversations that you're having with all of the interested parties. So if you know that the new accounting will trip a covenant, you should start having those conversations really early on in an informed way. And as we talked about a few slides ago, most bankers are willing to kind of adapt. They're not trying to have you trip a covenant just because the accounting standards have changed. It just might take some time really for everyone to get used to how things are going to look going forward and really figure out the best way to measure each company accordingly with the changes. So overall, I think this is really just a change in mindset that once we get used to the new accounting and the financial statement presentation, we're here to help you, kind of guide you through the process and get everyone on the same page and get a head start before year end next year. Just check. I think we've answered most of the questions. If anyone has any, if you want to put them in the chat now. So there's a question. Will the changes affect straight line rent? Sounds like the changes only impact fixed assets like printers, copiers, etc. I'm wondering if the straight line rent question is more geared towards an office lease. I'm not sure what you mean by.
Yep. So as far as what asset classes on operating leases they're going to have to be parked in the balance sheet, there is no carve out for any real estate. So if it's an office lease, if it's a warehouse lease, if it's a port lease, all of those, if they have fixed terms, if they have fixed or fixable payments, those will need to be present valued and parked in the balance sheet as well.
I think that was the question I'm getting at.
So like I said, like Emily said, the quantitative impact on the financial statements the numbers will be very large. That being said, to remember too is that this isn't happening in a vacuum. To Mark's point, it's going to increase comparability. So it's not just going to happen to your company, it's going to happen to every company in the industry. And like Emily said in her slide, just the last slide, the biggest challenge here will be the human component of it, that getting over some of those golden ratios and golden metrics we have in our head, because those are going to be changed by this lease accounting standard. And that there's mechanisms you can do via backing them out, changing the covenants, whatever the case may be, in order to accommodate for that.
Yeah, great points. All right, well, thank you all so much for listening today. Looks like the questions have kind of trailed off. We really appreciate your time and your great questions, participation. As always, feel free to reach out to your Citrin Cooperman team or any of us directly with any specific questions or concerns that come up. And we'll be publishing a link to the recording and materials, so please look out for that in the coming days. And thank you again.